Welcome everybody. My name is Stefan Friedrichowski. I'm with the company Trading Stars, which is a partner of Argus FX. And today's webinar is all around developing trading strategies, and it will be a series of webinars, an ongoing event. And I'm glad to have you here within that team of developers, so to say. And that is quite nice. And I hope you will enjoy this webinar as well as all the following ones. Yeah, today's topics, or before I start topics, just maybe a brief note to me whether the screen is all right and you can listen my voice. So if anybody simply would use the chat functionality of the webinar software or the question answers, both is possible. To give any note to me whenever you have questions. You can interrupt me, or you have maybe general questions, then I will postpone them to the end. But of course, every question is welcome. There is no bad question, no stupid question. Everything is allowed, of course. So I hope still that everything is all right. That means technically you are well connected, and so we can start. I have 4 topics for today. Of course, since it's the first webinar of this series, a few words about me, and then I want to outline a little bit what I intend to do over the next couple of weeks, months, years with you together. So you realize already it's not something I want to present only. So I want to invite everybody to be part of that team we want to create here. Third topic then is a principal approach of how to develop strategies. I will show you how I typically work, and one final thing I want to share with you is to have a different view on trading itself. So trading from a statistical standpoint or perspective, just to open your eyes what statistics means to trading, which is already quite interesting. Yeah, let's start. So, who am I? Stefan, that's for sure. And you realize that I'm not a native English guy. So I come from Germany. My age is exactly 50. It's not long ago that I celebrate that event. My background is simply education-wise. I have a PhD in physics and have worked as a physician in several divisions, several companies over 20 years. And 4 or 5 years ago, I decided to sell my company and to transfer myself simply to trading. So since then, I'm a full-time trader. Developing strategies, trading for my own, trading for others, trading for brokers, cooperate with brokers, as the case here with Argus FX, which is a very nice broker to deal with. And I do webinars. But finally, at the end, all is around strategies for trading. So I do this job now. Trading itself is maybe about 20 years now, but really as a full-time trader since 4 or 5 years. So I know about what I talk here. I know all the ups and downs, and maybe it's important to know that from my end, you will never hear stories of glamour, stories of how to get rich quick. That is not my part of the business. So I don't want to sell dreams. I only to sell the truth. I want to deal with facts, and I want to deal with the facts as they are. And yeah, just to be honest, just to share with you what is a real trading and not the dream of trading, who a lot of people might be interested in, but that's not the reality. So yeah, that's simply me. I'm sitting here in not in a company. I'm sitting in Radebeul, which is a city close to Dresden. Yeah, and from home I do my business. So that's about me. If in case you have any questions in general, you can always contact me, and you are invited to contact me at my email address, stefan@trading-stars.de. You can always send me an email. We can Skype, we can discuss, because finally I want really to share with you ideas. I want to help you with your ideas, and that is the purpose of the webinar series. Let's go into that a little bit more in detail. What I meant with the seminar and what are the topics of those Thursday webinars at all. Because it's not a course like visit 3 times my webinars, and after 3 times you are a qualified developer of trading strategies. You know all the details, you know how to do it, and that's it. No, that's already, once again, quite too easy story. Developing trading strategies is not something you can just learn in a few hours, and even the same with the trading and all, that you can't learn it with 2 textbooks and visiting 3 webinars. It's a process. It's a process, and within that process, I want to help you, I want to assist you, and I want simply to share all my knowledge with you. So the topics are always a little bit different. Sometimes it's maybe a little bit more for beginners, sometimes it's for already trading experts, developer of trading strategies. I will mix all the topics so that over the time I get all of you on the same level, but it's simply a process. So I want to have a different view on trading. Because for me, trading is not looking to a chart, drawing some nice lines, and say, hey, when if the price goes back to that line, then I know exactly what happens. No, that's not the kind of story you will hear from me. So I always investigate everything from a statistical standpoint. And only if I can see an advantage in the probability of my potential trade, then that is something I want to trade. But without any probability advantage, no trade. So what I want to share with you is all the methodologies I use and all my approaches to develop trading strategies. So it's sometimes maybe like a school lesson, sometimes it might be an interactive discussion with you about other methodologies, other approaches, but in general, yeah, there will be a lot of things you can learn from me during those webinars. When we talk about trading strategies, then we automatically come to optimization, doing back tests, and so on. Optimization is a very critical thing. Optimization means, okay, you have a basic idea, but now you want to find what is best. And yeah, even if you are already at that level that you can do those kind of things, which is not quite simple, but even then, you can do so many mistakes, so many misleading things. The classical answer here is do not over-optimize your strategy. But what does it mean and how to avoid? And what are the real good approaches to not over-optimize, to know exactly what will happen, what might happen? That are the questions of optimization techniques. Within this webinar series, from time to time, I will completely open the process of developing a strategy really ready for trade. So if I will do that in this case, finally there will be an account which will be exactly processing that strategy. And if I talk about accounts, I always talk about real money accounts, no demo accounts. I use demo accounts, of course, but only for testing expert advisors and testing some methodologies of expert advisors, for example. But finally, everything has to go into real money accounts because that is the holy truth and nothing else. You know, all what might happen can happen in demo accounts, so we will see the complete result only in live accounts. So one part is really that I will develop not only one strategy, but it will take a time, a couple of weeks, then we have a complete strategy ready for trading. What I also want to do here is that you get really new input and new ideas around trading. Topics you might not have heard right now, topics which seem to be quite strange. If I talk, for example, about entropy trading, entropy may be something you never have heard. It's something out of physics. But the funny thing is, entropy, for example, is quite suitable to enter into trading. Just one word about entropy. Entropy is disorder or a measure of disorder, and that is something which is very close to the price development of any underlying. Same is true for anything which is related to random walk. Random walk is something you might realize with every price of every underlying. If you simply look to a chart, it often looks quite randomly, and the simple answer to that is that's true. In most of the cases, most of the time, the price is simply more like a random walker than something which is predictable. But how to get access to those time regions, I will share with you as well. Of course, everything here is around statistics. We look back a couple of years, months, different time frames. We have price histories of, for example, any Forex with thousands, 100,000s of prices. So since we have always lots of data, we have to apply statistics, and that is, you have to learn a little bit about that if you're not familiar with statistics already. And another example, how to come to strategies which are self-adapting. Self-adapting means that the strategy itself will change its behavior because the price is developing differently to a couple of weeks ago or a couple of months ago or years ago. So how to come to strategies which always try to figure out what comes now best. So is it the right time to change some parameters? So simply think about you use an EMA in your chart, and you make decisions from that EMA relative to the price. So always the question is, what EMA period apply. And maybe it's good to change. Sometimes maybe 200 is good, sometimes 150, and so on. So to have strategies which look to, for example, the EMA and adapt what needs to be done in order to improve my results or even to get positive results, that is a topic as well. And always questions and answers to your own ideas, we can deal with that within the webinar. So I think if we get used to each other after a couple of weeks, I can reduce a little bit what I present, and we can have more open discussion here. And that is something I want to do with you as well, because the exchange of ideas and information is always something which helps a lot. From my end, there are no secrets. When I started the kind of business, I have had the opinion, oh, I will never talk about what I'm doing here. That is mine, and if I share it with others, then it will not work anymore, and others will be getting rich. No, those are stories of the history I want to share, open, and whatever is needed. So you can ask me any questions. So finally, I hope you keep on being curious and that you will take part of this webinar, which might develop into something like a forum as well, that you become very active. I know it's not the easiest task, but there will be the time you will enter any discussion with anybody, because you're getting more and more information, you're getting better in terms of trading strategies, and then of course you will try to share all your knowledge with others as well. So question and answers always welcome. You will get answers, and but at least there must be a question. Okay, so that was simply the general approach for this webinar series, that you know what you can expect over the next months and weeks, always same time. And yeah, you have two possibilities. One is always this 11 a.m. webinar, and there's another one at 7 p.m. The second one, then I will talk German. The other one, I will talk English. So what you have on this slide is my principal process of how to develop a strategy. So I call it the trading strategy developing circle, simply because it's a closed circle, because the final results might always give new ideas, and therefore it's a never-ending story. The starting point, if we are really starting that circle, the starting point is an observation. We all look to charts, of course, maybe too often sometimes, but we look to charts and we might see something which is sometimes repeating, or we see something that goes into profitable trades if we would follow that idea. So we have those kind of principal observations. They might relate it to indicators, or they might be related even to two underlyings or three underlyings. If the one underlying is doing that, the other underlying will do that. And this will do would give me already a probability advantage. And those advantages is something we look for. So those observations come out of simply your ideas, simply an observation in the chart. And just to have an example, For two underlying example, maybe you have the observation that if on Friday the Dow Jones within the last 2 hours from 8 to 10 increases, then on Monday morning the DAX, for example, will do the same. Just this might be an observation, a simple observation of something you realize several times. And now there's a critical part already. If you have an observation like this, and you look maybe a couple of weeks backwards into your charts, then already you have not anymore an open mindset. It's the same like all the other trading ideas. If you have an idea, you will always see that idea in the chart. So you get something which will be confirmed just by looking. The funny thing is that we always overlook, that we not realize that there are a lot of other examples which are not good. That is always the same if somebody is talking about a chart, drawing some arrows, drawing some lines, and hey, this was a good opportunity to get short in euro, US dollar. Of course, quite easy. If I know the future, I can draw those lines very well. But we have to do all our decisions now when we do real trading. So we have the two approaches. One is the observation itself, but that is not enough. We have to investigate that observation, and that pure by statistical analysis. Not looking to the chart and always see the good things and forget the bad examples. No, it has to be a pure, only mathematical investigation of what is our observation. So we need to go, in my example, to maybe 5 years backwards, ask always the same question: hey, is the Dow Jones increasing on Friday? And next question, is then on Monday morning the DAX increasing as well? And if you follow already that a very easy example, which is not meant to be true, but I only use it as an example, you automatically see the next questions. If I say the Dow Jones is increasing, also climbing up on Friday evening, what does it mean? Is 5-point increase already or do I need 100 points? Or even better to say percentage-wise, because if I go 5 years back, then the Dow Jones might be on a totally different level, so a percentage description would be more applicable here. So we have to define what is an increase. And that already gives you a hint of, hey, there are some parameters we have to fix. We have to decide so that we really know what means an increase. For example, a definition might be, it must be minimum 0.5%. Good answer. But at least it's a number, and then we can have strict rules, and we need those strict rules for our strategies. So following that example, we would have to define what is an increase, and then we have, of course, to define when do we enter a trade in the DAX on Monday morning. Okay, that's maybe only a definition. We will enter it at 8 o'clock when the market opens. Next question, do we have a stop loss? Yes or no? If so, how far away? And automatically we generate the next important questions in order to really create trades. Because the information, the DAX increases on Monday as well. is not a trade. That is only some saying. So we have to think in trades. Okay, we open, for example, at 8 o'clock. We have a stop loss. We have to define a stop loss, maybe 1%, whatever. But we see there are the next kind of parameters. Then the final question, when do we close our trade? Do we have a take profit? Is there maybe something I always call a time stop? A time stop would mean we close the trade regardless whether the trade has reached stop loss or take profit, but we close, for example, at 12 o'clock, or we close at 10 p.m., for example. So we have to define all those things, and this goes into the statistical investigation of our basic idea, and we can validate our principal idea if we go through that process. Validation here means that we may try different time periods, and with different time periods, in this case, I do not mean that we have M5 candles or D1 candles or something like that. No, what I mean is that we investigate our observation, for example, for 2015. And we might realize, a good thing is the minimum increase, 0.3%, and stop loss of this, and take profit there. And then we ask ourselves, is there a difference in 2015? What is about 2013? Is it always the same? Is it behaving differently? If it's totally different, we might need something which is adapting, whatever. So we have to deal with that kind of question. And this is the validation process of entering a new strategy. If it's still looking good, our basic idea, then we will, out of that former process, we get finally our fixed rule setup. Fixed rule setup means we have all the parameters we need. We have, if we apply EMAs, we know, okay, we need an EMA with a period of AT. Or we need a breakout time for a specific underlying between 8 and 12 o'clock or whatever. So we have a fixed number of parameters, a fixed setup, and all those parameters have been derived from our optimization process. Then we come to the next step, because if I talk finally about trading, my trading is always automated, because if I have everything ready, everything defined, then the trades do not need me anymore, because all the rules are established, everything is quite well known, so there's no question. Me personally is not needed anymore in order to do the trading. That can be done by the computer, that can be done by an expert advisor. So this is the final step, and sometimes it creates already the next observation. What we need within the process is that we continuously control our basic idea, that we control the real trading results, and that we set up exact limits of what we expect, and even when do we stop that strategy. Also, that question should be answered even before we start trading in a real money account. So we have to set up rules even for stopping, exiting that strategy. Even that must be fixed. That is a general developing circle, and that is how I work. And what I do is, in the final end, I try to establish one strategy per month. Sometimes I succeed with that, sometimes it takes a little bit longer. For whatever reason, computer time, optimization needs more computer power. Yeah, all things can happen, or even on a very late stage, it turns out the strategy does not work. And then I have to restart. All things happen, and yeah, what you can see, just as an example, that's maybe a little bit additional to what I'm doing personal. Here you can see the screen of a server running in total 18 accounts with expert advisors. Oh, I have to correct myself. One is only a logger account. There I only look to the spreads of the different underlyings. So that is what is achieved already. A lot of strategies are running all in real accounts, all on that kind of server, and all running with expert advisors. Okay, let's go a little bit more to the basic elements of a trading strategy. You have just learned my circle of how I do the work, but we need some additional elements as well. What is my expectation about rules? Rules which describe a strategy. There are some minimum rules which have to be fulfilled. Of course, some might even be quite simple or obvious, but we need to emphasize that we need those criteria. One criteria, for example, is that we need a clear definition. What is our entry? When do we start a trade? And of course, we need an exit criteria. Both is 100% needed in order to have trades. Of course, we need a method to calculate our position size. So to answer the question, do we buy 0.1 lot or even 1 lot or 0.05, whatever. So this must be one element of our strategy as well, how to calculate our position. So the lot size of the trade. All strategies I do have a stop loss. That means every trade in the millisecond it is opened has a stop loss, and no exception. I can think about trades without a stop loss, but only technically. That means, just as an example, if I would have, for example, a trade running on two underlyings, two indices, one, for example, a long trade in DAX and a short trade in the Dow Jones. Individually, the trades do not have a stop loss because they should compensate. But as a bundle, they have a stop loss, of course. So it's only a matter of definition. If I define a stop loss only as being set via MT4, then in this case it would not have a stop loss. But the two trades under the observation of an expert advisor, they will have a stop loss if it turns out to be not running. So a stop loss is a must. All those rules here are a must. A might have is to take profit of a trade. It might sound a little bit funny that I don't have to take profits in all my trades, but the more important thing is written here. If we have an exit criteria that might fulfill totally to not have a take profit. What does it mean? Think about a strategy. You just follow an EMA and whenever the price crosses the EMA, then you will change the type of your trade from long to short or short to long. And in this case, you have to close the old trade, and that is an exit criteria. And if we have that exit criteria, we don't need a take profit. So both is possible. Sometimes it's simply because of an indicator that the trade will be closed. Whatever is necessary, we can have here. So not always a take profit, but an exit criteria. Just as a few examples of what is possible and what is of ideas I have already done and I will do in future is, I just want to mention them, that you have trading strategy which are based on an EMA or even several EMAs. Think about the so-called rainbow trading. All is possible, and there are good things you can do with EMAs. And within this webinar series, we will of course have some ideas based on EMAs as well. Another principal type of trade or trading strategy is so-called breakout trades. That means you have two different times, maybe within a day, let's say 8 o'clock, 12 o'clock, and in the chart you would now draw two vertical lines, those two times, and simply ask the question, what is the price doing within that time? And this will fix a price range within the time frame. And now you can have this breakout trades simply by having a stop buy order at the upper end and a stop buy order at the lower end of that range. That is a basic idea, which is quite good, but needs careful consideration of what are the right times and so on. A third principal idea to follow is always so-called power candles. Power candles are those candles which you obviously will see in every chart because they will more or less jump in your eyes. And those power candles sometimes related to major events like FED or EZB in Europe, or even just complete other events like wars, terror attacks, whatever comes. If you see those power candles, you have a signal of the big market player, because in this case they will show up and you can use those power candles in order to develop strategies as well. A little bit more related to the classical technical analysis are things like corrections. Corrections, you know that sometimes one tries to describe the movement of simply by progression and regression, so ups and downs which repeat each other. And if you have a correction, then it might be a good time to enter a trade. So you can use the indicator RSE for this case, for example. That's just another idea. In principles, one might follow technical analysis a little bit further by defining resist supports or even formations of candles, but that is something I personally do not do. Simple answer to the question why. It's not quite easy to define a resist, a support, or a formation. There are possibilities to do so, but normally it's very hard to have them pure mathematically defined. But principle possibly answer yes, but not very easy, and therefore I do not do something like that. Finally, all what might be related to price relations or so-called spread trades or ratio trades, another name for that. That is simply that you have two underlyings which are quite familiar to each other. Think about gold and silver, or think about oil in the type of Brent or WTI. Those underlyings cannot go independently for a long period of time, especially talking about these two oil kinds of then yeah, it's of course obvious that the one cannot increase the next couple of months and the other can will always decrease, because if that would be the case, the industry might or will change and use the other one instead of the first one. So therefore those ratio trades is a very good strategy because it's a more neutral strategy. So quite interesting as well. So those are basic elements, and finally a trading system is a well-defined rules set without exception and no room for interpretation, because I don't want to have the question, is that already what I intend to do, or is it not? No. It must have well-defined rules without exception and no perhaps, always only a yes or a no and nothing else. Within those trading strategies, we have always a limited number of the degrees of freedom. And maybe you remember that my basic education was physics, and you might call them parameters like EMA, values, the period, whatever. All those parameters or degrees of freedom of a strategy, the number should be limited. My personal experience, it should be in the order of 4 and not more, because the more parameters or degrees of freedom you have, then the risk for over-optimization is increasing. So that is already a critical number. How many parameters you have within your strategy, the more the better. Yeah, the answer is clear, yes. Then the results will become better. But the predictability, oh, is that an English word? No. If you want to predict the future, then you might realize that too high number of parameters will end in a not very good strategy. But now, I always say a good strategy or having a good strategy. Just think about that question a little bit more in depth. What is a good strategy? This maybe funny question is quite more complicated to answer than on the first hand. Because what is a good strategy doing? Is maximum profit the thing we want to get? Yeah, on the one hand, of course, we all want to have profit out of our trading strategies. But is to maximize the profit of a strategy the right answer? Obviously not, because think about a strategy which might gain 1,000 euro on a 1,000 euro account within one year. But during the time, you have been at minus 5,000. Okay, that's not practical in your account, but is that a good strategy? The answer is no. So to minimize the drawdown, which is the highest loss from a temporary maximum in your equity curve, so to minimize the drawdowns is something which is important as well, because we want to have both. We want profit and we want to have small drawdowns. So if you want to maximize the one and minimize the other, then it's always good to have a ratio out of those two. And what I always do is I have the maximum drawdown and I simply divided that maximum drawdown by the gain of the profit per day. So that is my typical function which I want to optimize, and in this case I have to minimize, because if you think about this, I want to have a small drawdown and a high profit per day. Finally, I put something else into that equation, that is R square, that is the linearity of the equity curve. That sounds a little bit mathematical here, but let's look to an example. Here we have 4 equities of an account starting at 1,000 euro, and after maybe 1,000 trades we have different profits within those accounts. Very high one here, low one there, and now the simple question is, which equity is the best? You might give me a hint here, which you would like to have within your account. And maybe the first answer is, I want to have the red line here because it's doing the best job by having the highest profit. But my favorite out of those 4 equities, even to say everyone is very good, but the favorite here out of those 4 is the equity number 2. That is this one, a little bit violet. This one is the real best. Why is that the real best? Because it has a gain, so the slope is positive, and the drawdowns within this behavior are very small. If you compare it to the red one here, okay, the slope is minimum double as high, but the drawdowns within that equity are even higher. Not only double, much more. So finally, you can scale the equity 2 by increasing the risk per trade, entering here at 5,000 euro as well, and still the drawdown is smaller. You can see it by your eyes already. So for a second I will go back to my definition. So if I have this equation, maximum drawdown divided by profit per day, and then once again divided by this linearity of the equity, which is the number between 0 and 1, and 1 means a straight line. If this equation goes to a minimum, then it is the best one at all. There's a question, what is the gain per day if there is a loss on a day? The gain per day is simply the slope of the equity. So it does not ask for a single trade. It's, in this case, I go back to the picture. Just a second. It's the slope. If you would do a regression line into that equity, you get the slope of the equity, and the slope is nothing different than the profit per day. Of course, there might be days which are not profitable, but the slope is just one number describing the overall behavior after 1,000 trades. Okay, yeah, it's a gain after n days divided by n days. That's correct. It's not mathematically correct, to be honest, because it's not looking to the start value and end value and then divide the difference by the number of days. It's a so-called regression line, which is a little bit different, but that's a little bit more, that's too detailed. And in most cases, it's more or less the same. If you don't have very strange behavior, it will be more or less the same. So we now know how or what to optimize, but still there's the question, hey, if I now find a strategy telling me that should be the equity, I still don't know whether I have over-optimized, and so on and so on. So those kind of questions we will deal with over the next webinars as well. But it's what I simply want to show here is the one final equation I always look when I deal with the strategies, and that is this number we describe here, because if this number goes to a minimum, then I know I have a good strategy. But next questions will be how to avoid over-optimization, because if I simply took those parameters which generate a minimum value there, then I have an over-optimized strategy. But let's see. Okay, I promised at the start that I want to show you one additional thing here, that is to change your view to trading. And that is already a little bit displayed or in that graph here, because trading is a series of trades added to each other. Might sound simple and obvious, but it's always good to know that it is exactly that way. So we have a couple of trades, and we have always the question, is everything all right, not all right? And let's have a look, what does that mean? I simply have prepared a very easy Excel sheet, just that you know what I'm talking about here. And in this Excel sheet, I simulate trading. Simulation means, in this case, it's a little bit like with coins. So there's some randomness here in my trading results, and I only need 3 numbers for my definition. I have a win rate, I have an average gain and an average profit and an average loss. That's all. In this case, it's quite simple. 50% win rate, gain and losses equals to each other. So the expectation value of that strategy is quite simple to calculate. It's simply 0. But let's have a look. Since I can randomize it, I get always, if I press F9 here within the Excel sheet, I get different equity lines. Although we know that the expectation value of this, let's call it strategy, although we know that the expectation value is simply 0, sometimes, and here I simulate trading for half a year, sometimes even here we look quite well, and sometimes, in this case here for example, everything looks well, and sometimes it looks bad. why do I show something like this? Let's make a different example. Think about something which only has a win rate of 25%, and of course this account would go to zero quite fast. But now let's assume that we have 45 as the average gain. If you look to those numbers and calculate by your own a little bit, you can do the same then here in the Excel sheet. Once again, the expectation value is 0. And now let's make this a little bit profitable. So now we have really, which is already mathematically a profitable strategy. So the expectation value per trade would be 1.2 euros. But the average gain is 45 and the average loss is 15. But now think about your own trading experiences. This would be nice if you see that. Okay, let's have a look to this one. Really think about you start trading. You start with that kind of strategy within that account with 500 euros. It goes down. Okay, then a little bit up and even more down. You are happy once again. You are already above the 500 euro line. Very good. And now the disaster begins. And you are here, a little bit higher than 200 euro. And now the critical question. What does it mean? Of course, most of the people would stop their strategy somewhere here. But in this case, because everything is mathematically defined, I know that it is not a good idea to stop here. I know that the expectation value of the strategy is 1.2 euros. And this is only what sometimes I call it a statistic one event, because it's a single one. And in this case, I have a very high drawdown at the start. If I would repeat everything, oh, this case would even worse. But in average, I know the value. In this case, everything is well defined, so 1.2. In average, it should go upwards. So to know the numbers of a trading strategy, of expectation values, of those win rates, average profit, average loss, to know those numbers will help to go further in applying the strategy into a real money account. Because we know what can happen, but only if we know all those numbers. The truth is a little bit more complicated than my simple Excel sheet here, because I have assumed, the numbers as they are there. No trading costs, no spreads, no slippage, no overnight money, nothing. But it's only to show you what it means to have a real trading account and analyzing that real trading account, because we see what can happen and what will happen. To have that exercise always in your mind is extremely helpful to follow strategies. Because we can do that is sometimes called a Monte Carlo simulation, those kind of, let's call them experiments, and we know what is the range of the typical behavior. This might be a little bit more obvious if I look for a second here for this graph. Here I apply the same strategy 20 times. Some accounts would have been ruined, and most of the accounts go upwards. So that is like what is real trading. And that is, by the way, the next answer. We need several strategies. to have only one is not good. Everything here is simply done randomly, so it's quite easy. By the way, the thick violet line is the sum of all, which goes there, which goes in most cases really upwards, because it's the sum of all the individual accounts. And that is diversification of trading strategies, yeah, on a short notice here, or just as an example. So that is something we have always to keep in our mind when dealing with trading strategies, dealing with real money accounts, and looking to results we have in those accounts. We have to compare what have been in the past, what are my expectation values, and then I can set up limits. Am I still within those limits? I can proceed following that strategy. Or is something wrong and I go out of those limits, then I have to stop my strategies. But in order to really set up those limits, I can use those simple calculations, because I have a feeling, but it's more not only a feeling, I have mathematically well-defined numbers to help me dealing with my strategy. Well, so that was the first hour of this series, and I hope you enjoyed everything. And you will see we have a lot of topics, and there will something new for you, I hope, every week. Maybe there might be a week you know already each what I'm talking about, but even then, take it as a refreshment of your own, take it and go further with your knowledge, and maybe we can exchange a little bit more in the future as well. So in principle, if you have any questions, remarks, just send me an email to stefan@trading-stars.de. And of course, still I have to thank you, Argus, to make the webinars here together with you. And yeah, you can have an account at Argus, and we will talk later about that as well. You can have access to the Argonaut social trading platform, where you can find myself as well. But we will see during the next couple of weeks what can be reported there as well. That's for now. I hope you all have a good day. So there's still some time, but it of course depends from where you are, and still think we have some people from Asia, so their day goes already to an end. All of you, time. Thank you very much. Bye bye, Stefan.